You may have heard of Roth IRAs. Some of you may not know what they are at all, and some of you may want to know, okay, what are their best ways to maximize these Roth IRAs? Either way, I'm going to give you the full ultimate guide to Roth IRAs. I'm Derek Mazzarella, a certified financial planner with Gateway Financial Partners. Let's get after it. Okay, so what is a Roth IRA? A Roth IRA is just a type of tax treatment of an account. Okay, when it comes down to investing, all investments are typically taxed in one of three ways. So the most common one most people typically refer to is an IRA. So that money is put on a pre-tax basis, the money going in. So you take a deduction today for it on your taxes. It grows tax deferred. You take money out in retirement, you're taxed then. So that's going to be anything traditional in front of it. Traditional 401k, traditional IRA, traditional 403b. So you're not taxed now, but you're going to be taxed later. Another type of account is typically an investment account, but you use money you've already paid taxes on, so after-tax money. The money grows, and throughout the year, you actually may get taxed if there's any dividends or interest earned. And then if you sell it and there's any gains, you're paying taxes on those gains. So not as tax efficient as some of the other options here, but gives you some flexibility. And the third one, which we're going to focus on today, is the Roth. So we use after-tax money, so similar to this account. The money grows tax-free. You take the money out, hey, tax-free. So you pay taxes today, but then you essentially never pay taxes again on this account as long as you pertain to certain rules that we're going to go over today. Okay, and one of the big misconceptions I get is, all right, well, what's the return on my Roth IRA? It's such a misnomer. And what I want you all to think of this as is think of each one of these buckets here as a garage, and your investments are the car. You can put any car in each garage for the most part. So the return on your traditional IRA can be the exact same return as your Roth IRA. It matters about what you put as the car or the investment in the type of account. The type of account itself does not have a return. Just want to make sure that's clear. I get that all the time. You may think it's silly, but people are always asking me that question. All right. So next question, who can contribute? So Roth IRA is a little bit more exclusive than traditional IRAs because they have some exclusions about who can actually contribute. So the IRS sets income limits every single year for individuals, or if you're married filing jointly or have another tax treatment. Basically, if you make too much money, you cannot contribute directly to a Roth IRA. And you'll understand why I say directly in a little bit. But basically, if you make under a certain amount, you can put money right into a Roth IRA, no problems. 401k, it's like a Roth 401k. You can put money in no matter what your income is. So if you make $2 million, you can put money directly into a Roth 401k. So one of the big benefits of the 401k is you lose that income limitation restriction. Okay, but how much you can put in? So for 2026, you can put up to $7,500 into your Roth IRA directly. If you're over 50, you can put an additional $1,100. These typically will go up a little bit each year. Some years they may stay flat, but generally each year these will typically increase a little bit. So you're restricted from how much you earn to put in money here, and you're restricted for how much you can actually physically contribute in here. Now there's actually two other ways you can contribute to a Roth that don't involve putting money directly in there. So one other thing is called a Roth conversion. That means taking money that was IRA dollars that has not been taxed yet and then making it into a Roth IRA. So basically what happens is you've got, let's say, a traditional IRA over here, and then you want to make this into a Roth. What happens is in this conversion piece here, this is when you would pay taxes on it. So let's say you converted, $10,000 from a traditional IRA to a Roth, you would pay income taxes in that year you did the conversion. As basically it means like, hey, if you made $100,000 a year, you converted 10,000, you're going to show $110,000 of income to the IRS for that calendar year. Okay, so basically you're paying the taxes today to make money into a Roth IRA. You can say, like, why would anyone do that? There may be a down market year. There may be a low income year. Maybe you're in between jobs and you're would be making 250,000. Now this year you're making 150, and it's a good opportunity to take advantage of the tax difference you have. Or maybe you run a business and it's a bad year. I do actually have a full video on when's the best time to make Roth conversions, so feel free to check that out. So you can put money directly. You can make a Roth conversion, but those higher income people are probably thinking, well, that's not really fair. I make too much money and now IRA account sitting outside here with $100,000. The IRS is going to do what's called a pro rata rule, which basically means that if you have IRA money outside, they're going to only say, okay, a certain percentage of the backdoor Roth that we put in there will be Roth money. The other percentage will be after tax dollars. And you have to track this. It can be very challenging. Think of having a coffee and putting cream in. It's going to be challenging, pretty much impossible. So that's basically what's going to happen. I would recommend that if you have an IRA and you want to do this strategy, you should probably put it into your 401k, as long as it makes investment sense for you. But just one thing to caveat there. So just to recap, you can put money directly, you can do a Roth conversion, and you can do a backdoor Roth conversion. Those are three ways you can access the Roth IRA and put money into a Roth IRA. Okay, each have the pros and cons. All right, so the other thing is, when can I take money out? With a traditional IRA, you typically 59 and a half. Okay. The benefit of a Roth IRA is you actually have greater access and liquidity to this money. And when you put money in, two things are going to happen. You're going to have what's considered your contribution. And then eventually, or hopefully, you're going to have some growth. Don't make the mistake of just leaving money in cash. I see that all the time. Trust me. All right. So the contribution. Now, if you remember earlier, a contribution is using after-tax dollars. So it's money you've already paid taxes on. So the IRS says, hey, look, we already got our taxes from you. If you want to put money in and take money back out, you can absolutely do that. So if you put in 50 grand over the years, you can take out $50,000 of the Roth contributions at any time. You don't need to be 59 and a half. You don't need to have it in there for a certain amount of time. You can just take that money out. Now, the growth is a different story, because that's the money that's earned tax free. So it's the later of two things. Okay. So it's a 5-year rule. So 5 years from when you put the contribution in to where the growth is, or age 59 and a half, whatever's greater. So if you're 25 right now, that 5-year rule is not going to really do too much for you. You're going to have to wait until you're 59 and a half, or else you're paying penalties for that. Okay. There are also some exceptions to this. Let's say if you have a total disability in your life, if you die, your beneficiaries can take it out earlier. Unreimbursed medical expenses, you can take actually up to $10K for a home. So there's definitely a little bit more liquidity with these Roth IRAs than you would kind of normally think. Hey, I'm just putting this money in and I can't possibly use it for anything else for retirement. So it does have some flexibility. Just make sure you check the IRA rules to make sure that it's money that you could take out prior to 59 and a half. Some of their options are substantially equal payments till you're 59 and a half. So there's a bunch of different avenues to actually take money out. Now, when it comes to conversions, we mentioned the Roth conversion earlier. So taking money that's IRA money, getting it taxed on it, and then making it a Roth, it does have a 5-year rule on that. right? And that is based on every single conversion. So let's say you have a plan to convert, 5,000 a year for 5 years. Each conversion point for the five is going to have its own 5-year window. Now, if you're over 59 and a half, you don't really have to worry about it. It's just going to be on, how long the IRA was open for. So as long as it's been open for 5 more years, you're generally pretty good. It's just this 5-year rule really goes to those folks that are under 59 and a half. And generally, you're still going to have to wait to 59 and a half any way to take the money out, but just kind of know that each conversion has its own 5-year window. There's another 5-year rule when it comes to inherited IRAs. Whoops, if I can spell. Basically, that's money that you would get from like an uncle or a parent that passed away and gave it to you. It's a non-spouse beneficiary. And basically, if the Roth IRA has not been open for at least 5 years, you would have to wait till that 5 years is up before you could take the money out. So if the IRA has only been established for 3 years, you've got to wait the extra 2 years to go and take money out of there. Okay. All right, so a Roth IRA can be a great tool. The one thing you really want to look at when figuring out, okay, like what do I choose between the traditional IRA and the Roth IRA? The real thing is everyone say, oh, you get all this compound growth with Roth IRAs and blah, 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 blah. The math usually doesn't actually work out that way. When it comes to like IRA, like a traditional IRA versus a Roth, the real thing that you really want to look at, and this is almost, I would say impossible, but it's going to be really challenging to look at, is you really got to look long term at your taxes today and your taxes later, right? Because really only the arbitrage is what am I paying on taxes if I put money in an IRA versus what am I paying now? So what's your tax bracket today versus potentially later on in the future? So generally what I've found is that when you're on the younger side, you're earlier on your career, you're typically going to be in a lower tax bracket because you're probably not at your highest earning income years. So that's when it typically makes more sense to kind of check off the Roth box. Now, if you're 55, 60, you got a few years left and you're making your highest earning years, you probably want to look at the traditional IRA. Okay. Generally what I found is most kind of have a kind of challenge like this. Let's say like this is the Roth over here, right? And this is IRA. You typically want to probably start out more Roth and then kind of convert a little bit to IRA as you get older. So start with a Roth here and then maybe do a little 50-50 mix halfway through and then kind of end more with the traditional Roth at that point, because you want to take advantage of whatever tax bracket you're in and whatever tax bracket you think is going to be in the future. Taxes are historically low now. They most likely will not get much lower than this, if at all, if I had to guess. So taxes may increase in the future. So always keep that in mind when it comes to the overall situation and then your personal individual situation on whether a Roth IRA makes most sense or a traditional IRA makes most sense. Sometimes it's just like, hey, I'm going to use my 401k to take the pre-tax deduction, and I'm going to use a Roth IRA for my after-tax deduction because I have more control over that. I can take money out. Maybe I want to use that for a house or for education in the future, or maybe I just want that extra liquidity of having to be able to pull out my contributions. So there's a lot of things to think about when it comes to, okay, what makes more sense, a Roth IRA versus a traditional 401k. Those are some factors you really want to think through when it comes to Roth IRAs in general. I went over a lot of information there. This is always going to be based on your individual situation. So make sure you double check with a tax professional or another financial professional to see if this is the right fit for you. Overall, I think Roth IRAs and Roth 401ks are great tools. I typically recommend, most people actually have all three of these types of tax streams because it's going to give you a lot more flexibility when you get to retirement. Because when you're working, you really don't have a lot of tax levers to pull, especially if you're W-2. But when you're retired, you can say, I'm going to take money from my Roth, I'm going to take money from my investment account, I'll take a little from traditional, or maybe you do some conversions earlier on and lean, so you can really manipulate your tax bracket much more effectively in retirement when you have these three buckets. And you can use them well to really minimize your overall tax burden over the course of your life, because that's the name of the game. It's not like, hey, just let's save as much taxes as I can today. It's how do I save the most amount of taxes over my lifetime? So I'm Derek Mazzarella with Gateway Financial Partners. Hope you learned something from this video. If you did, feel free to like, click, subscribe, tell your friends, tell your mom, who cares?